So Fannie Mae had a big announcement over the last week that became effective November the 16th, and that is that they are removing their minimum credit score requirement from their underwriting software. It used to be a 620 was their minimum score, and if you didn't have a 620, typically when we ran that underwriting software, we would not get an approval for your pre-approval. So they have essentially removed that score. So that means everybody just gets a conventional loan now, right? Not quite. Well, let's talk about what the change actually means. So there's been a big push over the last couple of years to remove the FICO score algorithm that lenders have to use and to move more towards a Vantage score, which incorporates other items such as your rent payment and your utility bills to show an actual history of usable credit and on-time payments. We're not quite at that point yet, but this removal of the 620 score is Fannie Mae's kind of roundabout way of starting that process. So again, typically you needed at least a 620 to be approved for a conventional loan. However, every lender will have typically an overlay, meaning their own requirements for credit or debt to income ratios that you have to be able to get a conventional loan with that lender. And that's typically based on what their investors who purchase their loans are willing to purchase. So that's why you have typically heard you need to really have a 680. And that could be due to an overlay item or the fact that typically a 620 credit score may also have other debts, may have collections that need to be counted as part of their debts, or higher car payments because their credit ends up giving them worse interest rates. So it wasn't always that a 620 was getting a conventional loan, truth be told. However, again, Fannie Mae is saying they're going to take that out of the underwriting software, so it's not going to just be looking at a score to give its automatic approval or not. So we then have to, as lenders, look at the entire credit profile to see if someone qualifies or could do a conventional loan. So let's kind of talk about what some of those items we'll be looking for are. So while we're not looking for a specific score, lenders will still have to look at what creates that score, which is your utilization on credit card accounts, so how much of a balance you're carrying versus how much you could carry, if you have on-time payments on your open credit items, and if you have any collections, including like bankruptcies, foreclosures, student loan collections. Those are the items that end up making up your credit score. So even though there's not a minimum score required, we can't just disregard credit altogether. We're still going to have to look at your total credit profile to assign the amount of risk that there is. And that comes from the fact of if there are a history of late payments or are multiple collections, especially on items like cars or apartments, there is a higher risk that that person would foreclose or not make their mortgage payments. So we still have to look at the total profile. However, now we can look at other items as well that will carry a little bit more weight, such as your debt to income ratio or your reserves. So you may be able to now be approved with a 600 credit score on a conventional loan if your debt to income ratio is low and if you have a lot more reserves in your bank account. So that can be a good thing. However, there are some caveats to having a conventional loan with lower credit. I've definitely had borrowers below the 680 mark who have gotten conventional loans before. It's not very common though, because what happens is the lower the credit score, the more there are loan level pricing adjustments to your interest rate. And that determines how much your interest rate is going to cost. So an interest rate for a 6% may cost you significantly more to be able to lock into than someone with a 700 credit score. So if you're looking to get a conventional loan and you have what they call subprime credit, which is typically below that 680 mark, your interest rate may have to be higher based on the amount of money you have towards buying down your rate. So your payment may be higher. The other big thing we will definitely see with, again, those what they consider subprime credit scores below 680 is mortgage insurance cost. So conventional loans always have mortgage insurance if you're not putting either an amount down and paying the remaining mortgage insurance balance or putting 20% down to have it automatically removed. And depending on the credit, the debt to income ratio, that determines how much that mortgage insurance is going to be monthly. It is not the same for every single buyer. So if you do have a lower credit score, a lot of times that mortgage insurance will be substantially higher. So there are definitely times where someone, even at a 680 score, could have done a conventional loan, but it may make more sense for them to do an FHA loan, depending on what they want their payment to be. So it is a positive in that we can continue to look at your entire credit profile, look at other compensating factors you have, like low debt to income ratio, good reserves. We can look at your rental history sometimes, especially if you don't have credit established, to show on-time payments there. So that is a positive. I don't think, however, we're just going to see a rush of 500 and 600 credit score borrowers going conventional, even if they potentially could, because their mortgage will still likely be significantly higher. So if you want to talk about your options though and what it means for you as a buyer, definitely reach out. Let's go over your scenario.